Welcome back for part 2 of breaking down and understanding rehab loans. If you missed part 1, you can click the link there to jump onto that video and learn about what a rehab loan is, the loan process, and the first 2 types of loan options. Then come back to this second part where I am going over the last 2 types of rehab loans, how you may be able to include your closing costs into the loan, and how these loans can make you competitive against cash buyers. Quick summary, we went over the first 2 types of rehab loans that were FHA government-backed loans requiring 3.5% down at closing. A third variation of the rehab loans is the conventional. This loan requires at least 5% of the final loan amount put down at closing, plus closing costs if owner occupied. Again, this can be single-family home or 1 to 4 unit duplexes, triplexes, or quadplexes, as long as one of the units will be occupied. You can finance second homes with 10% down, and with 15%, you can use the rehab loan for single dwelling investment purchases. The conventional loan has a bit less red tape in that it's not government backed. It does not require having the HUD consultant part of the loan party. Loan limits for conventional loans are a bit higher than the FHA versions. For most of the nation, the conforming limit for single residences this year is $647,200. As was the case with the FHA loans, as you add units, the loan limit rises higher depending on the type of property it is and how many units there are. I will link the government's address for this information in the comments down below, alongside the FHA limits website as well that I mentioned in part 1, so that you can find your specific area anywhere across the nation and see what the loan limits are for any of the 4 loan programs. The fourth variation of the rehab loan options is a privately backed lender. These loans will vary in all aspects depending on the private lender or the entity that is working with a group of private investment lenders as to what their terms are and their allowances. As you can guess, these loans produce a bit more risk for the lender as they're fronting more money than the home is currently worth at the time of closing, and property may not be habitable quite yet. Due to this, rates are a hair higher in these programs, and there are a few additional fees at closing. You will also need to carry a builder's risk insurance policy during the course of construction, which may run a bit higher than normal home insurance as well. What if you have the money to put down, but possibly not all the additional funds for closing costs as well? Another unique feature of these loans is that the loan amounts can be up to 110% of the purchase amount plus rehab costs, or 110% of the expected appraised value, the amount that the appraiser believes the home will be worth after everything is completed, whichever of the 2 is less. As long as the 110% is still less than the max loan amount for the loan type and is not exceeding the loan amount that you were pre-approved to purchase a home for, this might allow for some wiggle room to possibly add the closing costs into the loan amount and be financed over the 30 years. Another thing the higher percentage may allow for is wiggle room on your purchase offer amount, possibly allowing you to beat out another buyer's offer, because many times the cost put into renovating a home is less than the final equity value acquired. Let me break this down. So as a complete example, say you want to buy a home that needs work. It's listed at $300,000, and you and your contractor are determining that you're going to need to put $100,000 into the home. Your loan amount will then be around the $400,000 mark. Your realtor may know, though, that ready-to-move-in updated homes with the same comparables of square footage and room count, etc. in the area that you're at are being listed at $450,000. Remember, as long as you stay under what your lender originally pre-qualified you for, you can borrow up to 110% of the purchase price plus cost. You can bump your offer up, say $30,000 to beat out the best deal finders, and offer the seller, say $330,000, plus add your $100,000 in repair, then you're in at $430,000. You're still likely to have more equity in the end once everything is completed than what you've put into it. Many times when buyers are purchasing rehab homes, especially cash buyers, they are trying to get the best deal they can as they have limited funds that they're working with. And if it's an investor, many times limited funds and small windows of time to flip the home before the costs of the project start eating into their profit. In essence, what this does is makes you more competitive against cash buyers because you are not working under the same constraints of limited cash or time. As you can see, there are a lot of variables in these loan programs. The rehab programs are very niche. And though most lenders all offer one or two of the variables, finding a lender that is proficient in rehab loans, or even better, has made rehab loans their specialty, will make for a much less stressful transaction. If you are in Oregon and need a referral, let me know. I can get you in contact with one. The nice thing then about having your rehab loan specialist is that you will not need to remember everything that we've just gone over. Between your lender, realtor, and contractor, you will have a team guiding you through the process. So go out, find the ugliest house on the market, find your diamond in the rough, and remember, with a bit more energy, instead of settling for what is on the market, you may be able to not only buy an updated home, but tailor it to your likings. If you found this interesting and or useful, please let me know by clicking the like button down below. Hit the subscribe button if you'd like to see what I have to say next week, and stick around to watch more about all things real estate related to living in, moving to, buying, and selling here in Yamhill County.